a ton of questions, but let me ask you a really straightforward and simple one first of all. What happened to staying independent?
Well, we are independent. No, I think this is a genuine merger of two independent asset managers to create what we hope will be a global investment company. No, I regard this as staying independent.
Let's talk about the responsibilities. I suppose everybody's itching to know. How is it going to work? Two CEOs. Many people have sort of questioned this. Tell us the split.
Well, I'm going to do external affairs, and Keith will run the sort of fabric of the business. And I think that plays to both our strengths. We'll both be doing the bits of the business we enjoy. So I think it'll work very well. Co-CEOs are very common in the financial service business. And in any case, it was necessary to do this, to bring together two equal-sized asset managers to create this, hopefully, a global investment champion.
You say necessary. Let's walk me through the reasoning behind it being necessary. Is this a defensive move? Is this an offensive move? What is the necessity?
Well, I think it's both, actually. I think it gives us a chance, as I say, of creating something that can grow. But it's also defensive as well, in that the industry is consolidating globally, and you either want to be big or small. And if you're going to try and compete with BlackRock at 4 or 5 trillion or whatever they are, there's no point being 200 billion. So this creates one at 660 billion. And if the dollar pound was at the normal rate, we'd be in the $1 trillion club, you know. So it's about creating size as well. Size matters in our business because the sovereign wealth funds want to give their money to the big global giants. And even when we do combine, we're still only going to be number 19 or 18 in the world. The other 18 are above us will all be American. So we need to be big to compete with these global giants.
Is that the ambition? Is the ambition to compete? You were very complimentary about the Janus Henderson deal. Is that the ambition? Is that where you want to take the scale of this joint venture, this combination?
Yeah, I mean, we'd like to take our product set to America rather than try and compete with them in the what I regard as the battleground of passive, which is US large cap. And that's where we're really seeing the pain, because if you ask a US fund manager, CEO, how life is, he's pessimistic, whereas the market is at an all-time high. So there's something not right, if you follow me, in the US fund management industry.
But is the trend going to change? Passive is here, it's big, it's going to be substantial for quite some time. It's dampening volatility, it's having all kinds of effects that we didn't think that it would. That trend exists. How do you, as an active manager, go to the US, compete, and try and set up shop?
Well, we're not going to try and compete with them on US large cap, but I think what we can do is compete with them on global equities, global emerging market equities, global debt, global credit. So one of the great advantages we have is being headquartered in Scotland, which is the ideal time zone to run an asset management from, and also our global. Bear in mind, we'll be unlike any other asset manager in the world. We'll have about 90% of our assets outside the US, whereas most US large fund managers have the bulk of their assets within the US. So we're going to be totally unlike any of the other big American houses.
We'll come back to the idea about the race to the bottom in terms of fees, but let's talk about the deal again. There are detractors who have said, because when I caught up with you in Dubai at the end of November, the end of the interview was, no, I'm in the market to find something substantial for myself. Here we are. Some say you have delivered not great value. It's an all-share deal, and that you should have squeezed a bit more value. What do you say to the investors out there that are criticising the value?
Yeah, well, I think we did squeeze some value if you look at the 30-day VWAP or the 60-day VWAP. It's just our share price rose the week before as people started to sense that something was happening. And it's still a mystery to me how these things leak. And of course, I owe our staff, our combined staffs globally, a huge apology for the way they found out about it rather than in a proper way, which was the most upsetting thing about the deal.
Is Scotland going to be a good place? You talk about Scotland being a good place to run a business.
Great place. Great place.
I just want to digress. I just want to.
You know where we're going.
This is the warm-up. Let's join the dots. You've seen the front page of the papers this morning talking about a second referendum being inevitable in Scotland. Does that change it as a place to do business?
Look, let's wait and see what happens. We operate in 50-odd countries around the world, so where we're headquartered is certainly of some significance, but we feel we can adapt whatever happens. I do know Nicola Sturgeon, and she welcomed the deal when I spoke to her on Monday. She recognises the importance of this for Scotland. And what I will say is I don't think she'll go for a referendum unless she thinks she's going to win it. And she is a pretty good politician, and she's not going to go through another referendum and lose.
To sort of circle back away from politics, this is about putting this deal together. You're going to do the front end of the business. Your colleague, of course, he's going to run the sort of day-to-day machinations of it. But when I look at the split here, integrating Standard Life and yourself, if I strip out some of the numbers, Aberdeen's got 52% of these funds and Standard Life has 48% of the funds. There's got to be synergies here. There's also got to be some costs to be taken out of this business, Martin. How are you going to do that? What can we expect from that in terms of this integration?
Well, we've put a figure of 200 million out there in 3 years. We'd obviously be disappointed if we didn't achieve that figure, and also within the timescale. My colleague Andrew Lang, the Deputy CEO, and Standard Life's Chief Operating Officer will be running the integration, because the vital thing is to keep integration away from business as usual during this period, so that...
Could the redemptions, do you think redemptions, I mean, that's the other thing, redemptions could mount, I mean, in this interim period, is that a fear? Are you fearful of that? Because you've had a tough time on the redemption front.
I think inevitably, when a deal like this is announced, anyone that was thinking of firing you or redeeming whatever is going to... It is definitely a trigger. What we've now got to do is convince people of the merits of putting these... And bear in mind, this will be a £750 million revenue equity business. It'll be the biggest multi-asset manager in the world, almost. It'll be one of the biggest property fund managers, huge credit fund manager. It's going to have massive scale in a number of areas. And it takes us both away from being seen as us just an emerging market house and Standard Life just GARS. So the benefits to clients are enormous in this transaction. And that's the key thing. Is it good for clients? Because if it's good for clients, it will be good for shareholders eventually, even though they might not, as you say, think it was the greatest deal on earth at this precise moment in time.
Culture. Let's talk about culture. You guys know each other. You're in the same place. It's a small little ecosystem. You all operate in the same sphere. Does culture work here? Is it something that you actually going to find fairly easy to deliver upon?
Yeah, I think so. And bear in mind that Standard Life is really two companies. It's really the investment company, the fund management, and the life company. And Jerry Grimstone has a strategy of inversion. He wants this to be an investment management company with a very powerful distribution life company attached to it. So the cultures of the two investment management companies, which is what we're merging, we're not merging into the life company, are very similar, both bottom-up, stock pickers, research-led, and I think it will go very well.
Let's get to markets in terms of animal spirits. Jamie Dimon is full of animal spirits. He thinks there's a great optimistic horizon for us. How optimistic are you about animal spirits in markets? Are you surprised we're seeing a ratchet in yields and bonds? We've got unemployment numbers today, and these equity markets keep thumping. How concerned are you about a bubble here? I'm
actually quite bullish on growth in the US, and I think that then leads on to growth in emerging markets and the rest of the world. So growth is not the issue. I think what worries me is that up until now, markets have been climbing a wall of fear, and now I'm a bit worried that everyone's euphoric, and that is when we normally see markets tip over. So I'm more hesitant about markets just because of that. Everyone thinks they're going up now, which is the worst place in the world to be.
Yeah. unless you're in the bond market when they're going down. And they've been going down pretty aggressively over the last... Have we reached a tipping point, do you think? Is that where you're kind of pointing us towards?
Yeah, definitely. I think especially, you know, as I said to Manus before, I think on the show, Trump has succeeded in doing what the central banks have failed to do for 10 years, which is to get interest rates starting to move up, and I think there is definitely the tipping point now.
A tipping point that could have tremendous impact in terms of the emerging market trade as well for you. Does that add fuel? Are you concerned for emerging market risk as well?
No, I'm confident on emerging markets because, as I say, I think America will grow. I think look, as we've said before, Trump will borrow and build and spend. I think that's good and for the world economy, and I think good for emerging markets. Emerging market debt is so cheap relative to developed market debt. I'm not too worried about it. India, you can still get 6.5%, 7%. So excellent value there. Buy the fund.